Stocks are sitting near record highs, and Wall Street is acting like the waiting room is empty. It isn't. July CPI lands Wednesday at 8:30 a.m. Eastern, and the bond market is already holding the bill. This is not a prediction about the number. It is a map of what has to move afterward before the headline becomes a real liquidity signal. The setup is unusually clean. The Fed held its target range at 3.5% to 3.75% on July 29th, but the vote was 9-3, with 3 officials preferring a quarter-point hike. On Tuesday, Fed funds futures still priced roughly a 48% chance of a September increase. That is not a settled market. That is a coin flip in business casual. June inflation cooled to 3.5% year-over-year, with core CPI at 2.6%, and economists expect another modest step down in July. But the first green or red candle after CPI is basically the market clearing its throat. The real question is whether the release changes the expected Fed path, and whether Treasury yields and the dollar agree. If CPI runs hotter than expected, the tighter risk chain is straightforward. September hike odds rise, yields and the dollar firm, and expensive long-duration assets lose some oxygen. AI and semiconductor stocks matter here because higher discount rates make faraway earnings less valuable today. Duration is wonderful when money gets cheaper. It becomes less charming when the discount rate starts lifting weights. Bitcoin belongs in the watch list too, but not because it is mechanically tied to CPI. In short, macro windows, it can trade like a liquidity-sensitive risk asset, so the confirmation is whether it holds or loses the move alongside yields, the dollar, and broader risk appetite. Bitcoin is many things. A Treasury bond with laser eyes is not one of them. The softer inflation branch is the mirror image, but it still needs proof. If hike odds fall, yields and the dollar ease, and market breadth expands beyond a narrow group of mega-cap winners, then the liquidity signal is stronger. If stocks pop while yields stay stubbornly high and breadth stays thin, that may be confetti before the receipt arrives. So the CPI number itself is not the verdict. Watch the sequence. Fed pricing first, then Treasury yields and the dollar, then breadth, semiconductors, and Bitcoin. PPI follows on Thursday, with retail sales data later in the week. The calm in stock prices is real. The unresolved risk is still the cost of money, and this market has to earn the all clear rather than assume it.